There's a signal buried inside the silver market right now that almost nobody outside professional trading desks is watching. It has nothing to do with the headline price. It's a number most retail investors have never even heard of. And market history says it has only shown up twice before in the modern era, once in 1980 and once in 2011. Both times, it came right before silver did something almost nobody thought was possible. That signal is back. It's been building quietly since last autumn. It never fully went away, even while the price of silver was crashing and rebounding. And this week, it's colliding with a Federal Reserve that just got blindsided by the worst jobs report in years. I'm going to show you exactly what this signal is, why it's genuinely rare rather than just internet hype, and what it does and doesn't tell you about what happens next. Because the honest answer is more nuanced than either silver's about to explode or this is nothing. If breaking down the actual mechanics behind these moves instead of just reacting to a green candle is useful to you, hit like, subscribe, and drop a comment. And I want to know something specific. Are you someone who holds physical metal, someone who trades it, or are you just here to understand what's going on? I'm curious how this audience actually splits, where things stand. Let's ground this in the actual numbers first. Gold has been trading in the $4,300 to $4,400 range this week, sitting near a 2-month high after climbing more than 9% over the past month. Silver has been trading in the mid-minus $60, touching a 6 to 7 week high, up sharply off its summer low. That summer low matters because it tells you how violent this year has already been. Silver hit an all-time high above $121 an ounce on January 29th of this year, then went through one of the steepest collapses in its history, eventually bottoming out around $55 in mid-July. 2 weeks later, it was back near $65. That's not a market drifting calmly. That's a market swinging through enormous moves in both directions inside the same year. What triggered this latest leg up was Friday's jobs report. The Bureau of Labor Statistics reported the U.S. economy lost 23,000 jobs in July, against expectations for a gain of roughly 80,000, a genuinely dramatic miss. And it wasn't just July. The prior 2 months got revised down so heavily that the trailing 12-month pace of job creation has collapsed to somewhere around 34,000 jobs a month. That's the kind of revision that doesn't just change one data point, it changes the whole trend line underneath it. The market's reaction was immediate. The dollar fell to a 2-week low, treasury yields dropped, and both metals surged. Silver actually more than gold, which compressed the gold-silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, down to around 67 from closer to 69 the week before. When that ratio compresses quickly, it usually means silver is being bought even more aggressively than gold, which is exactly what happened here. That's the surface story. And if you stop there, you'd have a perfectly normal explanation. Weak jobs data, rate cut bets, metals rally. Nothing unusual. But there's a second story running underneath this one that's been building for almost a year, and it's the one that actually explains why silver's moves have been so much larger than gold's. The real signal? Backwardation. Here's the concept, and I promise it's simpler than the name makes it sound. Under normal conditions, a futures contract for silver delivered a few months from now costs slightly more than silver delivered today because whoever's holding it has to pay for storage, insurance, and financing in the meantime. That's called contango, and it's the default state of almost every commodity market almost all the time. Backwardation is the opposite. It's when the price for silver delivered right now trades above the price for silver delivered later. And when that happens, it's the market telling you something specific. Enough people want physical metal in their hands immediately that they're willing to pay a premium for it rather than wait for a cheaper contract a few months out. That almost never happens in a market with abundant, freely available supply. It happens when the physical metal genuinely is not moving to where it's needed fast enough. Starting last October, silver tipped into exactly that condition, And by some measures, the backwardation reached its widest levels since the 1980s. Alongside it, the lease rate, essentially the interest rate someone pays to temporarily borrow physical silver, which normally sits below 1%, spiked as high as 39% in London before settling into a still elevated range through the following months. For context, a lease rate anywhere near 40% is not a rounding error. It's a market screaming that available physical metal is scarce relative to who wants it. None of this means the world is literally running out of silver. Global inventories, when you count everything sitting in vaults, are actually enormous. The problem is what analysts have described as a hotel with plenty of rooms that are all fully booked. The metal exists, but a huge share of it is already spoken for by ETFs, industrial users, or banks hedging their own positions. And it isn't free to move quickly to wherever the immediate demand is. So, why does that matter enough to build an entire video around? Because this exact combination, sustained backwardation, plus a genuine lease rate spike, is not something that shows up every year or even every decade. The historical parallel. Go back through the record of silver's price history. And there are really only two prior periods where this specific combination showed up clearly. 1980, during the infamous Hunt Brothers episode, when concentrated buying pushed silver into extreme backwardation, and the price briefly spiked past $50 an ounce before crashing. And 2011, when a similar backwardation and lease rate dynamic accompanied silver, very nearly doubling in price over the space of several months. In both of those cases, backwardation showed up first, as a signal that the physical market was under real stress, and a major move in price followed. I want to be careful with you here, because this is exactly the point where a lot of channels start promising you the next 10x. I'm not going to do that. What the historical pattern tells you is that this specific signal has preceded major moves before. It does not tell you that it guarantees one now, and it especially doesn't tell you the size, timing, or direction of any move that follows. Markets that go into backwardation can also simply resolve quietly, as metal eventually gets rerouted to where it's needed and lease rates normalize without a dramatic price event at all. That has happened plenty of times in commodities that never made it into anyone's highlight reel. What I'd say plainly is this. This is a genuinely rare structural signal, not manufactured hype. And understanding it puts you ahead of the headline-chasing crowd who only notices silver when the price itself is already moving. But rare does not mean certain. And anyone telling you it does is selling you confidence that the data doesn't actually support. Now, backwardation on its own is a signal about the physical market. It doesn't explain why this particular year has been the one where it showed up. For that, you have to look at what's actually been happening to supply and demand underneath the price chart. Silver is on track for its 6th consecutive year of a global supply deficit, meaning the world is consuming more silver than mines and recycling combined can produce. The projected shortfall for this year alone is estimated around 67 million ounces. And the cumulative deficit built up over the preceding several years runs into the hundreds of millions of ounces, a meaningful bite out of a market that isn't enormous to begin with. That deficit comes from two directions at once, which is part of what makes silver different from a purely monetary asset like gold. On one side, there's investment demand. People and institutions buying silver as a hedge the same way they'd buy gold, especially once gold's own rally made silver look comparatively cheap. On the other side, there's industrial demand that has nothing to do with anyone's portfolio at all. Solar panel manufacturing, electric vehicle production, and electronics all consume real, physical silver that then leaves the investable market more or less permanently. When both of those demand sources are pulling on the same limited pool of metal at the same time, the kind of physical tightness that shows up as backwardation becomes a lot more understandable. So, you've got a structural deficit that's been building for years, a physical scarcity signal that's historically rare, and now a fresh monetary catalyst from Friday's jobs report, all landing at once. Here's the part I'd be doing you a disservice to leave out. The honest risk silver is, and has always been, one of the most volatile major assets that ordinary investors can buy. This is a metal that went from about $40 to over $121 in the space of several months, and then gave back nearly half of that gain before this latest rebound even started. Anyone holding through that entire round trip lived through a genuinely stomach-churning stretch, regardless of where the structural story eventually lands. Backwardation and elevated lease rates also aren't a one-way signal. They can resolve gradually and boringly, with metal quietly flowing to where it's needed and rates drifting back toward normal without any dramatic price event at all. And even a genuine structural deficit doesn't prevent a sharp near-term pullback if the monetary side of the story reverses. If, for instance, this week's inflation data comes in hot enough that the Federal Reserve's September decision leans hawkish instead of dovish. The same opportunity cost math that's been pulling money into precious metals can flip and start pulling it back out just as quickly. This is not financial advice, and I'm not a financial advisor. I'm walking you through a mechanism, not handing you a prediction. Two things can be true at once. The physical market is flashing a genuinely rare signal, and silver remains a genuinely volatile asset, capable of moving hard in either direction on short notice. So with all of that laid out, here's what actually matters for the days directly ahead, rather than the abstract multi-year story. What to actually watch this week brings both the Consumer Price Index and Producer Price Index for July. And those numbers are arguably more important right now than anything happening in the backwardation data itself. If inflation comes in cool, it reinforces the case the labor market has already made for a Fed that leans toward cutting rates in September, and that keeps the opportunity cost of holding non-yielding metal low. If inflation comes in hot, the Fed is stuck balancing a weakening labor market against sticky prices, which is exactly the kind of split mandate tension that tends to produce choppier, less predictable moves in gold and silver both. Beyond this week, the more durable thing to watch is the lease rate itself. That number has been elevated on and off since last October, and if it genuinely normalizes back down toward the sub 1% levels considered typical, that would be a real signal that physical stress is easing, regardless of what the headline price is doing. If it stays persistently elevated or spikes again, that tells you the underlying tightness hasn't resolved, whatever the price does in the meantime. Here's what I'd actually leave you with. The backwardation and lease rate story in silver right now is a real, well-documented, historically rare signal not manufactured drama, and not something you'll hear about from most channels that only look at the price chart. It has shown up before major moves twice in the modern history of this market. It is not a promise of what happens next, and treating it as one is exactly the kind of overconfidence that gets people hurt in a market this volatile. So here's my actual question for you. Knowing that this specific signal has only shown up twice before, and knowing that both times it preceded a major move, does that change how you think about the metal you're already holding? Or does the volatility side of this story matter more to you than the historical pattern does? Tell me honestly in the comments, because I think this community is going to be genuinely split on that one. If this helped you understand the mechanism instead of just reacting to the headline, subscribe, because I'll be back the moment this week's inflation data lands to break down exactly what it means for both metals.